I am also going. I'm going. I'm from England and I'm going.
Welcome back to this week's episode of the Steady Trade Podcast. I've got a topic that, I'm actually glad. Stephen and I, obviously, we argue good-naturedly, bad-naturedly. We seldom agree, but it was kind of interesting as him and I were chatting through last week. Something I talk about a lot is, especially when we get through the earnings season or into earnings season, a lot of the times the lower price stocks can get a little bit quieter. And even anytime, year round, there's a common misconception with many new traders and with smaller traders where everybody kind of has this misconception that if you've got a small account or a medium account or a growing account, you can only trade the 50-cent stocks, the $1 stocks, the $2 stocks. And I chat with a lot of guys and gals that get a little frustrated because as amazing as the low price stocks are, we love them, we love them, we love them. I have a special place in my heart for low price stocks. They can tend to come and go. A lot of the time it's almost like the holiday season where it's very, very, very busy in low-price stocks, and then it gets very, very quiet. And a common misconception, as I said, is that traders don't realize that they can trade these higher-priced momentum stocks. You got to be selective. You got to pick the right ones. But if you catch the right idea at the right time, you can, instead of making 20, 30, 50 cents on a $2 stock, you can make $1, $2, $3, $5 a share on a 20, a 30, a 40, or a $50 stock. So you can get very similar percentage moves. And as Stephen and I have talked about, and he'll touch on, sometimes well, you won't touch anything. Thank God we do these remotely, but
never be in the bedroom again. I'm thinking bad things.
I am on vacation with the family, so that's why there is a bed in the background. This isn't the Steven Johnson dating episode of the Steady Trade podcast, but
it's a little bit sexual. It's like a sexual higher price stocks. Let's carry on. Sorry.
But I think when it comes to a purely technical matter and a charting matter, it can actually be easier to chart a lot of these stocks because the moves aren't as, I use this term a lot in StocksToTrade Pro, they're not as wonky. Sometimes, and Stephen's going to talk about his trades in Twitter, you don't have, as much as we love these low price stocks, you don't have these bizarro 300% moves 6 months ago on the chart. So they're actually a little easier to chart. So, Stephen, what do you think? Kind of break that down where you're coming from as well.
Absolutely, Tim. Thank you so much for the foray and the thorough introduction. That was very thorough and well organized and explained. I would come at it with what my preconceived preconception was, if that's a thing. And then I'm going to talk about how I feel about things now. So my preconceived preconception was that you used to be on StocksToTrade Pro and you used to be like, I'm looking at this higher price stock and that higher price stock and look at ROKD and look what it's doing now and look at RKD, whichever it was. And I used to be like, get
probably Roku.
ROKU. Probably none of them. Probably none of them. I'm probably double wrong. That's probably Roku. But
hey, man,
this is how accurate I am.
The listeners understand that alcohol is a leading contributor to brain damage. They all understand that. They're cool with it. So go ahead.
I'm trying to get better. And day by day with this podcast, with your support, I'm stepping out of addiction. To a better life. Thank you, Steady Trade Podcast, powered by StocksToTrade, for getting me out of addiction of alcohol and the very bad behaviors that have grown through me teens and developed. But ROKU, used to go on about it all the time, and I used to always think higher price stocks, less volatile, move more slowly, not as exciting, easier for older people like you to react slower to and still profit. Like they were like, do you know what I mean? They were like, I'm not gonna get a shock. I'm not gonna get a surprise. I'm not gonna fall off my chair, and it's all gonna be fine. And I was like, no, I want the excitement. I want the drama. I want the thrill and spill of the ride, like the Kumba back in the day in 1997 in Orlando. If it's still there, is the Kumba still there? Is the Kumba still there? Nah, it's not there anymore, is it?
I'm not sure.
Fastest.
I don't know. So I don't, so it's interesting. Even though I am in Orlando, I love all the parks and stuff. I from a trader mindset, I do not appreciate the risk to reward of roller coasters. Okay.
No.
Yeah, it's fun. It's interesting. But again, calculating the risk to reward, why would I put myself in a potentially life-threatening position just for the fact to have some fun? Now, I know they don't break all the time, but the risk to reward is terrible. I would never put myself on a janky roller coaster that's 20 years old, probably poorly maintained. And if it is maintained, it's maintained by a profit-seeking corporation that's going to do everything as cheap as possible and just try and maximize their profits. No thanks.
Tim, if you're going to have that attitude, you might just say, I'm not going to get out of bed in case I fall down the stairs.
Nah, different.
You've got to have balance. We're in trading. We've got to take risks. Got to take risks, baby.
Agreed, but unlike your degenerate ass, I like to manage my risk and keep myself out of potentially volatile situations.
So we're never going to go on a roller coaster together. I mean, that's the point of this. That's the point of the podcast. Let's wrap it up. It's finished. We're all done. No, but in reality, so making a bit of a joke because I'm just trying to make light humor on a humorous podcast to give it a twist. But the reality is, I thought there was not much volatility in higher price stocks. I thought that they were only for people with really big accounts, and I thought that there was no edge in them. And I thought that they were for these professionals on Wall Street who would really know what they were doing much more than I would, and I would just lose me money.
Now, I'll let you finish, but the one delineation I make there is the majority of them, it's true, but as you rotate in and out, there's typically a handful of very quote unquote hot higher price stocks. And, I'll let you finish where your thoughts were coming from. But, the perfect example is as we're recording, it's Twitter, it's Facebook, it's Snapchat, it's Tesla, all of these very news-driven stocks. Now, it's not, GM, it's not Microsoft, it's not Apple, it's not Google. Now, those stocks could become what is it, but the biggest separation is focus on those handful that are quote unquote in play.
But I mean, it's just the penny stock market has been quiet, and it's funny because it's been a natural evolution. I wouldn't say it was a revolution. I'd say it's been an evolution, and it's been an evolution because I went from $10 stocks to $15 stocks, $15 stocks to $20 stocks, $20 stocks to $25 stocks. And then when I saw Twitter, and I think Twitter is like a $32, $33 stock, something like this. And I looked at the chart and I knew that Facebook had its privacy issue, which was the number one first catalyst. And then when I saw that it was falling through 33, which was a whole dollar number, which was a second catalyst. And then when I looked at the 33.30 level and I saw that there was a gap fill where it had previously supported on huge volume, and I'm sure we can put that chart up. It had supported around the 33s on huge volume. So I thought if that falls through that level on huge volume, and we've got the gap fill, and we've got the whole dollar break, and we've got the privacy issue, I'm like, all I have to do is short the strength, cover into the dips. Short the pops, cover the dips, because all the long-term shareholders are done for.
I tell you, it's almost like, I love what you just did there.
It's almost like I built a kiss.
It's almost like a year into this thing, you've actually fucking started listening to me, man. I love it. Because, back that up. If you're listening on your podcast app, hit the rewind button like 30 seconds and hear what Steven did. He took into consideration technicals. He took into consideration fundamentals. He took into consideration the news, the hot trend. So, Twitter had been running for months and months and months, gapped up huge on earnings, big gap up. I mean, probably, quote unquote, too big of a gap up for a high market cap stock. Then it continues to trend. Then we get the negative Facebook privacy news, which is ultimately spill over to Twitter, I'm sure. I mean, all these social media stocks have a bullseye on their back right now. When Zuckerberg gets dragged in front of Congress, I mean, it's not going to be good. But I love what Steven did there. He built the case. Now, does that mean he's going to profit every time? But no, you put that situation in your favor when you've got technicals, fundamentals, news, charts, all this stuff that comes together. That's what avoids randomness. That's what heightens your potential for success right there.
And just the other thing is, and then after that, you can just, like, I've been playing Twitter for the last few weeks, and it's literally just, it moves very smoothly. Like, if you saw Facebook today drop at the open and then come back up, it was a perfect V. There was no crazy volatility. There was no scary jumps and random sells and big shareholders massively influencing the pricing structure, because it's such a high float. You don't have these fluctuations which are as volatile, and you kind of trend following a little bit more. And
yeah. And again, we talk about, like, and I can't remember if you necessarily use VWAP a lot, but I mean, a lot of these stocks, they'll make that big move initially, whether it be a big gap down or a big gap up, and then they'll just kind of trend with VWAP and trend. And then you can, whether you're long or short, you just kind of ride that momentum. Twitter was I think Twitter's on the lows. Twitter's on the low of the day right now, if I remember right. Yeah. I mean, it just keeps fading all day. It's sitting on the low of the day right now. And, whether you use VWAP, whether you use a 5-minute or a 15-minute chart, you can just kind of let these things work. Once they start reversing against you, you take your profits and you look to retrade them down the road.
But and I mean, also, if you're a kind of a support and resistance trader, you're just literally looking to think, right, once this gets to this resistance level over the last few days or the last few weeks, ideally, the longer the resistance, the better. Then I'm just going to watch this and I'm just going to wait. And if not enough volume comes to push this through, and it starts to have one or two little red candles, I'm just going to build in. And I'm going to risk the top of the resistance level. And I'm risking 10 cents, 15 cents, and I'm covering every single dip. And I'm just like, this is mental. This is the bomb.com or the bomb.co.uk because I'm from England. Like, this is the bomb.co.uk/cool/easiermoney.com than penny stocks.
Now, right. So everybody, my big question for you is, I think probably most of the listeners kind of get what you're talking about, using the chart, using the fundamentals and all this stuff. But I know what everybody's thinking, and this is kind of what I touched on in the introduction. They're going to say, well, Steven, I got a small account. How do I trade a $30 stock?
Just leverage all in.
Just when I thought I was making some headway, I completely failed.
Just leverage all in. Just take the chance. It's safe. These stocks are safe. Nothing's going to happen. All in. Trust me. I'm talking to you. Trust me. All in.
So as Steven failed to give the right answer, what I will talk about, and I talk about this in StocksToTrade Pro, is think about the rule of 10. This is the best way to kind of conceptualize how to approach these. How to, a lot of the questions we'll get on the podcast is, how do I manage position size? How do I determine how many shares, et cetera? And the rule of 10 is what I take into consideration for small accounts with any stock over, pretty much over $10, because the majority of you guys with small accounts think you can only trade 50 cent, $1, $2 stocks, et cetera. Well, if you're trading $1 and $2 stocks, trying to catch 10, 20, 30-cent moves, think about these higher priced, more volatile stocks and just divide the price by 10, divide your position size by 10. And now, instead of trading 1,000 shares of a $2 stock, or in Twitter's consideration, I mean, Stevens shorted a little over 28. So instead of shorting 1,000 shares of a $2.80 stock, you can short 100 shares of a $28 stock. And and if you were perfect, it's down almost $1 a share, making new lows. Hell, by the end of this podcast, it may be down $1.50 a share. And think about that. You've now made $150, couple $100, $300 on 100 or 200 shares versus trying to make that $200 or $300 on 1,000 shares or 2,000 shares of a $1 stock.
Yeah, and I mean, I just couldn't believe it. I mean, it took the negative catalyst for me to take the jump to short the higher price stocks. But I was literally, when I was putting 100 shares in and 200 shares in, and all of a sudden my account was going up $80, $100, I was just thinking, I literally can't believe this. I literally cannot believe in them. And I'm writing on Twitter, I'd be like, I can't believe I'm shorting Twitter and making money. Everyone on Twitter was like, welcome, you finally realize you can actually make money on the higher price stocks.
You know, and it's funny, I've seen a lot of your trades, and oddly enough, as well as you've done, and you might correct me on this, in my opinion, you would have done way better if it wasn't for your time zone, because I've seen you've been covering at like 11 a.m. because it's late your time, where I think if you were in a more friendly time zone and weren't determined to go out and, and get drunk every night, you could let these things work all day. Like what did you cover Twitter at today?
Now, the way I've been trading recently with Twitter, it spiked to around around 33 was the previous day high. And I'm literally taking 50 cents, 70 cents, a buck at the most, and then waiting for a bounce and then shorting the bounce, letting it dip, covering the dip, covering the dip, covering the dip. But with
like today, what price did you cover at today?
I took like 50 cents on it, 70 cents, 30.
But you were probably out in like the 28s or something, weren't you?
Nah, nowhere in, yeah. So in the morning, do you have a chart up?
Yeah. Yep.
What did it spike to in the morning? Because I caught the top.
It spiked to 28.80.
Okay, so it spiked to 28.80, and I was out at about 28.30, 28.20.
Okay.
Didn't take more than 80 cents on it. I couldn't believe it went down further.
Which is a beautiful trade, but it doesn't really matter what day it is or what the trade is, but
I can make more,
crushed it. Yeah, he made his 50 cents a share. But the time zone isn't very comfortable for him. He's got other commitments. He's got work, etc. And now the stock's $1 lower and making new lows. So with 100 shares or a couple hundred shares, you can make $200-300 a day. And it does not take you long to grow an account. It does not take you long to get over the PDT. You would be amazed at how fast a small account grows when when you're winning at 60-70% and adding $200-300 each trade, and you can do that 100 shares at a time with these stocks.
I feel like we should make this into a book and call it The Secret. I really feel like we're like this episode is not going to get watched by enough people. I know this, and people are not going to take it seriously, but it's the truth. Like for me, I was like, it's like Willy Wonka and the Chocolate Factory. I was I feel like I'm the girl who ate the blue bubble gum and turned yellow or whatever. But that's a weird analogy, but I feel like it's too good to be true, or I've just been lucky for 6 weeks. Do you know what I mean?
Well,
I'm
but
not sure.
See, the biggest crux is, and if you're listening to this episode 6 months from now or a year from now, the biggest key takeaway is we're talking about Twitter, we're talking about Snapchat, we're talking about Tesla, we're talking about Facebook, because those are the in-play stocks. What happens, the biggest mistake and the biggest frustration that small traders get into is they start trading the non-in-play stocks. And then they're like, oh, man, this thing moved 10 cents today. Yuck, I want nothing to do with that. And I know I'm the conservative old guy, but I want nothing to do with a stock that's moving 10, 20, 30 cents. But if you can use the power of, obviously, StocksToTrade to screen for these stocks, Twitter's a great resource. Twitter's a double-edged sword. But you can, with the right following, with the right list, you can see, okay, these are the big name stocks. Read the news. I mean, I don't think anybody, now I don't know how soon in the future this episode will air, but as of April 3rd, I don't think anybody has escaped the news on Facebook and the privacy stuff and selling of data and all of that. You need to then be like, oh, wow, okay, this is on the news every day. This is something I need to act on.
No, and just, I mean, there's two other major advantages. I mean, one, when you compare, you can always get borrows of the higher price stocks. So it's a misconception.
Yes.
It's a misconception to think that you shouldn't short successful companies. I'm not shorting Twitter and Facebook, the successful companies. It doesn't matter. They still get overextended. They still need to retrace. They still have bad news. They still can't break through key resistance levels. You can short higher price stocks, and better yet, there's always borrows for them. You're never going to run out. Generally, for me, I've never had a problem.
Yeah. It's painful. I mean, it hurts my soul right now to thank you for remembering that point.
It's very important.
But it is because, I'm sure a lot of the listeners maybe have come to the podcast because of Tim Sykes, because of other short bias traders, and that's great. But, one of the things that Sykes will always talks about is ELFs, always look for shares to short. And that is so frustrating because you can look at these stocks. SLS is a great example. Bring up the chart from April 2018 on SLS. I mean, the stock is up 200-300% on the worst news. Well, not the worst news, but iffy news. But nobody can borrow it. LFIN is a great example. This stock was $70 3 days ago. 3 days ago, it was $70. It's now in the single digits. Nobody can get a borrow. So you can stare at those. You can stare and stare and stare at those charts, and you could be, oh, this is the perfect setup. But if you can't get a borrow, it's a complete waste of time. You wasted your mental energy. You wasted your time. Whereas these higher float, quote unquote, real companies, I mean, you can have any brokerage account and get a borrow on Snapchat, Facebook, Twitter, Tesla, et cetera, et cetera.
And I just want to add to that point. We're getting ramped up here and I like it, but if you can get a borrow on SLS,
I get excited when when you actually make good points. Like 2 or 3, you built the case. You brought up a great point about shorting low float stocks. It's like I get so excited when you actually make good points.
I'm so productive right now, but I know some people who actually did get borrows on SLS on the first year that it was up 60%. And I've got to tell you,
and they probably got ripped for freaking 50%.
If you got borrows on SLS, you needed an SOS because your ass was firing to the moon. And you kind of get out. I'm sorry to say it, but I didn't get the borrows, thank God. I know 1 or 2 people who got the borrows, and they took big losses. We're talking thousands of dollars.
Yeah, that's the double-edged sword of, and we actually, a great episode, a recent episode was with Phil Godeker. Phil's a great guy, Ozark Trades, and it's that early short, and we talk about this a lot. You can make good money on that early short, but man, you got to be willing to endure the pain, and it's a big account game. That is not a small account game game to try and short day one, day two right now. So
I mean, and as you know, I've been pretty profusely tracking data. I'm trying to use big words. I'm trying to use big words to make me image better after the alcohol teenage years. Pretty profusely been tracking data. You need to look it up.
Well, I yeah, actually, okay. No, I don't think it's a traditional usage, but I'll let you slide there.
Profusely is absolutely 100% the correct word to accurately describe this phenomena that I'm about to.
It's funny as I Google profusely.
You're a reader. You're a profuse reader. You should know that profuse is the right word.
It's funny that you're wearing the tank top again, and if you Google that, it is though. Look, if you Google profusely, the first suggestion is profusely sweating, which is kind of what I always think about when I see you in this tank top. So
I am not profusely sweating in this room. You don't realize this room has got really heavy air conditioning. I feel like a mouse in a freezing cold cave. Like that's how I feel right now. I'm the opposite of sweating. But as you know, I've been profusely sweating.
Tracking data.
I'm profusely sweating, and I need to go to the doctors. No, I've been profusely sweating, and it's a real problem. And girls don't want the datas because I shake their hand and they're like, "You're profusely sweating," and I'm like, "I know, I've got a problem. I need to go to the doctors." Do you want to come back to my house? No, because you'll profusely sweat all over my body. Anyway, when we're on top of each other kissing.
Oh, quit it. We're PG rated here.
You're in the bedroom, and I'm thinking weird things. But I'm profusely tracking data, and this is a good freebie. And only since February, since I've been tracking data, only 2 stocks that gapped up more than 30% pre-market. Only 2 of them ran, or maybe 3, 2 or 3 maximum. It was 3. Only 3 of them ran more than 10%. That gapped up more than 35% in the last 2 months.
Interesting.
Right? Get this. 2 of them were under 5 million floats. So what does it tell you? Don't short floats under 5 million, because as soon as the double, triple, quadruple the volume, yeah, it's like an Elon Musk spacecraft.
And that's that. We should probably talk. We might even have it might be a little boring, but we should have an episode where we talk about float rotation, because a lot of guys and gals will ask about that idea, and they'll be like, "Hey, Tim, why are you always don't short low floats day one? Don't short low floats day one." Well, that float rotation idea, and we'll save it for another episode. But like you said, I mean, it's so easy for a stock with less than 5 million float to rotate the float. I mean, SLS traded like 18 million shares yesterday, I think. And it's a 1.5 million float. I mean, it's like, if you're shorting that stock, good luck, brother, because you're going to need it. So
every single long trader is looking for a squeeze. Every single one. Like if it's a low float, I'd never short it. I mean, you can short it, but if it starts basing, you've got to get out. I'd never short it on the first green day, and if it does have a first green day and it gaps down the next day, everyone's looking for that to go red to green as well. They're the two shorts you've got to be very worried about.
So I do want to kind of double back to what our original agenda item. So what if I'm the listener and yes, I'm looking to kind of maybe test, which remember, StocksToTrade has a paper trading module, great way to test, or you can test with a spreadsheet. You can test with a pad of paper. I mean, there's a million different ways to do it. But say I'm looking to dabble, venture out into these higher price stocks. What are you looking for tomorrow, Stephen? What are you looking for next week? Give me an idea of what I should be kind of scanning and looking for to kind of test this higher price strategy.
One other stock that was really good recently, if you ever see, was ACXM. Was it ACXM that got sued 25 million by Facebook? Had a major gap down, all the shareholders panicked and it dropped. I think AXCM or ACXM, but it's just another chart to think about.
Okay.
That was probably one of the biggest wins I've ever had was shorting that, and that was just the other week. But what I would be looking for is, for me, I've recently changed my StocksToTrade scans. They were 25 cents to $5, then 25 cents to $10. Now they're 25 cents to $200 because I want to have Tesla in there as well, and Tesla's like 220 or something like that. So change your scanners immediately. Look for the particularly volatile stocks, and then start tracking them. And
now, I can answer, but
yes, you know better than me. I'm just
I mean that's a kind of nebulous term. You said look for the most volatile ones. So
what kind of term? What kind of term did you say it was?
Nebulous.
Nebulous? Let's just Google nebulous. What does nebulous mean? What does it mean?
You tell me what it means.
I can't. I'm in the bloody desert, man. Me computer will blow up if I try and do this recording. I try and do this. There's a camel walking past the apartment right now.
Nebulous. The definition of nebulous is in the form of a cloud or haze, a hazy. So
I made a hazy term.
Well, no, it's just, again, a lot of the listeners might say volatile. What do you mean volatile?
Okay. So go on. So you can answer or I can answer.
Well, the biggest thing I'm going to look at is that daily range. Okay. So what I'm looking for is stocks that have, that are making big moves relative to the price per share. So, a 10-cent move is a volatile stock for a 10-cent stock. But a dollar stock that moves, and when I talk about the daily range is the low of the day and the high of the day. So a 10-cent range on a $1 stock is nothing. A $10 or a 10-cent move on a $20 stock is really nothing. So I want to see big moves relative to the share price. So if it's a $1 stock, I want to see $1, $2 moves. If it's a $20 stock, I want to see $4, $5, $10 moves. So if you're running those scans for those higher price stocks, and it's a $20 stock that doesn't have that much, a big range on the day, move it off. If it just a great example, say it's a $20 stock and it gaps up and then just goes nowhere the rest of the day. Yeah. That's something you probably want to ignore. You want something with big range, big movements like a Twitter, et cetera. So when you're looking at those charts, you're flipping through all your charts, look for the big range. You don't want a tight range.
So you're basically saying you want a big range prior to previous price action.
Exactly. So you should all be using candlestick charts. So I know if you're listening, you won't see my hand gestures, but if you've got, visualize holding up 1 inch in front of your head, and if you've got 1 inch candles and then a 5-inch candle, that's a stock that's interesting for you. You're looking for those big moves, those big candles relative to previous candles, and volume. Same on the volume candles.
But can I just ask you, what gets me is who's losing? Because who is losing? Because for me, it seems like, I hope this doesn't come across as now I'm getting a little bit discombobulated. But that is, I don't want to come across as a bit profligate. But do you know profligate? This is just like countdown. No, I don't want to come across as not
brain
like
damage.
I don't want to come across as a retard, but no, but I don't want to come across as this is too easy, because it's not easy. But who is losing because the strategy is very simple. If you short the strength and you sell and you cover into the weakness, or you buy the weakness at support and you sell into strength. I mean, surely these other experienced traders know what they're doing. So how are other people losing here? Is it shareholders that are losing?
Well, it's like any trade, whether it be a higher priced or a lower priced stock. I mean, never underestimate the foolishness, the irrational exuberance of longs or shorts. I mean, let's go back to SLS yesterday. I mean, even experienced traders. I mean, you made the point that you had guys that have been trading for a while that were excited to get a borrow. I mean, to me, yesterday on SLS, it's up 70% in pre-market. It's 1.5 million float. It's a reverse splitter. It has a headline out with cancer in the headline. I never once even considered shorting that stock. Yep. But you just mentioned that you have experienced trader friends that shorted it and got torched. Now, does that mean I'm smarter? No, I'm not making that point at all. But never underestimate the other side of the trade. And people can get irrationally exuberant, long and short, on real stocks and junky stocks.
And just in general on it.
But that's the beauty of it. If everybody was rational, remember that the irrational exuberance is what gives us these opportunities. If everybody was rational and logical, if everybody was, if the entire marketplace was made up of a bunch of Spocks, from Star Trek that did only logical things, we would never get these moves. So be glad that there are those irrational ideas.
And I am sometimes a Spock as well. I'm trying not to be, though. I'm trying to grind out of it, and I'm getting there. But like, how would you get into it though? Like, I got into it by moving up slowly, and then I just somehow started feeling comfortable. I don't know how it happened. It just happened. But how would you recommend someone got into it?
Well, the biggest thing, and we could probably finish on this. So we could probably report back on this in a few weeks. But always, and this is why in StocksToTrade Pro, I mean, Wall Street Journal is expensive. Investors.com is expensive. But, there's a value in reading the business news. There's a value of Twitter moments. I mean, are you going to go to the Twitter trending hashtags and see what the Kardashians are doing, or seeing what, Alonzo Ball is doing, or all of these pointless things that will never make you any money? Or are you going to pay $20 a month for the Wall Street Journal and know that Facebook is under scrutiny, to know that Tesla had 2 accidents under autopilot? I mean, be in tune to what is the current trend in the business markets, then take that over to your scanners and say, okay, wow, Facebook is under scrutiny. Twitter sells data. Remember, if with social media companies, remember, if the product is free, you're the product. Okay, so nobody should have been surprised that Facebook and Twitter and all of these are selling your data. You use these apps every day. There's no charge to them. That means you're the product, brother. So anyway, be tuned in to what the market is doing. Then take that over to your technical analysis, take that over to your scans, and then do what Stephen did 20 minutes ago and build that case and say, okay, Twitter's been uptrending for months, had a huge gap up the other day. There's negative news. It's breaking down through a whole dollar, half dollar. It's breaking down through those key levels. That's a short.
And Tim Bourne, as I live and breathe, I'm sorry that I doubted you. You are right with the higher price stocks. Ignorance is not bliss.
Well, and again, I appreciate the compliment. I gave you a couple compliments today, so I think that's a good thing. So anyway, the takeaway from today's episode is go back to what Stephen did. Look for those trendy stocks. Don't trade higher price stocks that aren't volatile, that aren't newsy, NEWSY. Focus on those. Look for the charts. Test, track your data, and use the rule of 10. The rule of 10 is so often misunderstood. If you catch a $5 move in a $20 stock on 100 shares, that's a good day.
Hi, this is Jeremy from Zimbabwe, Africa, currently living in Texas, and I like to clean the house while listening to Stephen and Tim on the Steady Trade podcast.
I actually doubt my wife's just in the room next to me, but
brownie points, you know what I mean? You can register to win real, actual prizes at their website, SteadyTrade.com. And if you really like what you hear, give the podcast a 5-star rating and write a glowing review on iTunes like I did. And this is how we say goodbye in Zimbabwe.